top of the heap here are those ETFs that have sectors that have more relative strength signals compared to the others. So all these ETFs are compared to each other, and on a peer-to-peer basis are ranked by stronger relative strength at the top to lower relative strength. And you can see things like financials, technology, industrial, healthcare are near the top. We have exposure to all these sectors. So even though we're underweight equities, where we are more focused on equities in that underweight allocation are in these stronger relative strength sectors. Hello, everybody. This is John Lodra. I'm the co-founder and partner here at New Harbor Financial Group for our weekly market video. The purpose of these videos are to bring data, our insight on that data, really for the purpose of educating and empowering our clients and viewers as relates to their financial lives. Today is Friday, August 16th, 2024. And as I record this, we're coming off a rather remarkable couple, 2-3 weeks in markets. In some ways, it feels like a year or many years have unfolded in the way that markets have moved. The title of this video, Market Whipsaws and Rotations, kind of says it all. We've seen quite a bit of whipsaw action in many different parts of the market and some subtle rotations that we think are perhaps emerging important trends to be watchful for. So this is a chart of the S&P 500. It's a daily chart. And you can see here the market peaked on July 16th of this year, just under 5670, 5669 and some change, and proceeded to fall off rather quickly here. And then a real sharp sell-off here. In fact, this date, August 5th, Monday, August 5th of 2024, was a real gap down. This was kind of felt like the markets were cracking in a very major way. We can pin it to all kinds of headlines of the day. There were ramifications coming out of the so-called unwinding of the Japan carry trade. My partner, Mike Preston, talked about that in our weekly video last week. But the essence there is that some actions by the central bank in Japan and some of the interest rate and currency moves in Japan caused a rather quick unwind of some levered carry trade. And that had some ripples. There was also headlines about a slowing economy, fears of recession, the SOM rule that is a bellwether indicator of recession triggered. A lot of different things were coming together at once. A lot of volatility and uncertainty regarding the election. We can name all kinds of things that came together. But the bottom line is we had a very sharp sell-off here. Markets were down, again, about 3% on the day, gap down the S&P. And just anecdotally, we saw a little bit of panic in our subset of our clients. They were worried. And even though we have a fairly defensive allocation, our clients were down about 1% on the day, give or take. But still, it's a big move. And we understand that even a move of that magnitude can rattle folks. But let's look at what that looked like. The measure of the volatility markets called the VIX. And this is a daily chart of the VIX. You can see on that day, Monday, August 5th, we spiked up to over 65, almost 66, and then proceeded in the coming days to have the most significant crash in VIX on record, right down to, basically as if nothing ever happened. And I'll just zoom out a little bit just so you can kind of see what this looks like. Last time we saw VIX spike anywhere close to this level was back in early 2020 during COVID. And then going back to the great financial crisis, the housing bust. So this was a really interesting and bizarre move, extreme move, not only the move up, but the move down and the speed at which to move down, almost as if the markets freaked out quickly and then nothing could go wrong. But let me go back to the S&P 500 on a daily chart, because I want to point out some of the tools that we have in our tool chest. This horizontal line here is at 5,200 on the S&P. And that's where we have currently and have had put options in place to take off about 15% stock market exposure in our client accounts. And until it hits that level, it's like an insurance policy. You bear a deductible. So our clients saw some downside on that portion of the hedge until it triggered right here. And we actually dipped below. And at that point, if the market had continued going further, these puts would have been very robust protection. Now, we did have seen a very sharp bounce here in the coming days, and that's one reason the VIX has come off and that kind of thing. And I'll talk about the texture of this bounce in just a moment. But we use this strength to extend our puts out to September. So we still have this line in the sand, tail risk protection. It was fairly cheap to do so because of the crash in the VIX. Let's talk about the market action. And we might as well look at a chart of the currency pair. When this chart is rising, it means the yen is weakening relative to the US dollar. And essentially, this whole year, we've seen a massive weakening of the yen and strengthening of the dollar. Until recently, we saw a very strong rally in the yen. And here's that August 5th pinnacle here, or trough in this chart. And already you've seen the yen start to weaken again. But that was a big move that had a lot of ramifications, and it's almost as if it came and went. With that recent re-weakening of the yen, and the Bank of Japan has come out and talked back some of their hawkish policies and maneuvers that have underlied the recent move. We're starting to see evidence that the market is already starting to kind of re-enter the yen carry trades. This is as of yesterday, I believe, maybe the 15th of August. Japan's currency has weakened more than 5% since August 5th. Nomura Holdings, Japan's biggest brokerage, has seen a variety of investors start borrowing the yen again to invest in the proceeds elsewhere in higher yielding assets. Suggests corporate clients and hedge funds who have been enthusiastic carry traders are getting back into these deals. So, this is reminiscent of the Wild West here. And I can't, as a steward of everyday people's hard-earned retirement assets, I can't help but shake my head on behalf of our team here and our clients that this is just really speaks to a kind of a casino-like market that, we don't think the froth and the extremes have been completely washed out. As I mentioned, we have had a pretty sharp bounce in the market since that August 5th low. We didn't do any selling. In fact, one of our key messages over the last couple of weeks is, we're very defensive already to begin with. We felt that the selling had gotten overdone. In fact, we did a little bit of buying. We had a little bit of equity exposure. We had to talk some clients off the ledge a little bit to not panic, even though they were down just a small amount. Really interesting dynamics, because we saw Ned Davis put out data point showing that what they call their sentiment composite, and it had gotten extremely pessimistic. And their research has shown when it got to that level, the markets have very strong tendencies to bounce. And in fact, that's what we've seen since that August 5th low in the market. I think the S&P is up about 8%, if I'm not mistaken, in just the 2 weeks or so since that. So a very sharp bounce. We just regained the 50-day moving average on the S&P and other broad indices like the Russell 2000 and that kind of thing. Really important proving point whether we can keep that 50-day moving average or the market kind of turns back down and takes that out. But that's all to be seen. We don't know what the future holds. We'll just have to watch and react. But if you look at some data that speaks to what underlied this sharp move, this is a chart that was put out, and this is as of August 13th. The net takeaway of this chart is that it seems like retail traders, everyday retail investors were in no small part the fuel to basically power this bounce. This is showing the net purchases basically by retail traders. So I hate to use the word dumb money because I think it's so condescending to everyday people, but the industry uses this euphemism of smart money, kind of the big institutions, and dumb money. And it has the markings that much of this rally was a frenzied buying by retail traders trying to get into stocks like NVIDIA on a pullback and things like that. All while big players like Stanley Druckenmiller and Jonathan Tepper were getting out of things like NVIDIA. So it remains to be seen how durable this bounce is, but it's really important to understand what was underlying it, or at least what appears to have underlied it. Dramatic whipsaws, when the VIX and these sharp pullbacks and rallies in the markets, really dramatic. We don't often see that, and it's certainly something we've taken note of, and we think most folks should take note, and not to panic, but just to be understanding that there's a heightened instability, we think, in markets that bears close watching. Getting to the market rotation side of thing, if we look at some of the moves in these markets, there's been some interesting kind of early trends that seem to be emerging. This is a chart that was put together by folks at NASDAQ Dorsey Wright, and this is as of August 14th. And it basically shows in the large cap US stock universe, if we break that universe into 10 deciles ranked by the strongest momentum to the lowest momentum. So strongest momentum is on the left side of this chart, slowest momentum or lowest momentum on the right side. What we see here is that most of this decline that happened from July 1st through August 14th was in the super momentum stocks. And in fact, really in the top decile. The rest of the universe was not so badly affected. In fact, saw positive gains. A really important kind of trend there. And it speaks to changing of the guard, so to speak, from some of these high momentum, mostly large cap tech stocks to other players. This next chart really gets to, we use many tools in our tool chest. One of the most kind of central themes of our investment discipline is what we call relative strength. And it simply is trying to measure different sectors, different geographies, different market segments relative to others in the same kind of universe, really to try to measure which are showing greater strength and greater resilience than others. It's fitting that we're not too far after the end of the Paris Olympics, and it's not unlike a sporting event where you kind of take track and field, for example. You kind of have various heats and various metrics to measure the athletes against each other. That's really what relative strength is in the way that we use it. And this is a chart, again, that was put together by NASDAQ Dorsey Wright, and it shows as of August 13th, 2024, so very recent, the various sector ETFs, spider sector ETFs. And at the top of the heap here are those ETFs that have sectors that have more relative strength signals compared to the others. So all these ETFs are compared to each other, and on a peer-to-peer basis are ranked by stronger relative strength at the top to lower relative strength. And you can see things like financials, technology, industrial, healthcare are near the top. We have exposure to all these sectors. So even though we're underweight equities, where we are more focused on equities in that underweight allocation are in these stronger relative strength sectors. We also have utilities, which have gained pretty remarkably, and it's one of the strongest sectors year to date, and has gained very pointedly on a relative strength basis. One thing I want to tease out, technology has been a leader for a long time, but there's been some notable degradation in the sector. And in fact, just recently we swapped out of a semiconductor ETF that we had in favor of the industrial sector. Semiconductors, within the technology sector, semiconductors had been one of the weakest, and we wanted to, on this recent bounce, kind of acknowledge and recognize that weakening relative strength and pivot in a more directed way into the industrial sector. But that's something that we see. This is something that we systematically review and follow on an ongoing basis. So we have seen some important rotations that seem to be passing the baton of sorts between different sectors. I wanted to kind of talk about, in closing here, bring a little levity into this. There's been a lot of headlines about inflation cooling, coming in with expectations. A lot of the economic numbers have become, a little less worrisome over 3 weeks ago, we were looking at impending recession. Then earlier this week, we had much stronger than expected retail sales number. So, let's call the recession off. The headlines have been whipsaw kind of headlines on these readings. But one of the things that's in the headlines is inflation. And this is really one of the reasons many folks think that the Fed is likely to drop interest rates at its September meeting. I will say market expectations have come off a little bit there. Just within the last week or two, there was an 80% market perception of implied probability that the Fed would drop 2 drops at the September meeting, 50 basis points, 0.25% drops. Now that odd is only down to about 23%. So more and more the market thinks the Fed will drop just one quarter percentage point drop in September. But there's been some funny stuff that's been posted online that I wanted to share just to bring some levity into that equation. So this is from Twitter. Someone here posted, "Can someone please explain to me in crayon how inflation keeps going down?" Because certainly that's in the headlines, and certainly the politicians want us to believe that it's going down, and certainly the Fed does as well. But we can continue to live in the most expensive timeline of our lifetime. So Nick Timmeros here, I think, did it great. In crayon, he rightly points out over time, since 1990, consumer prices have steadily increased. Now, the rate of change of that increase has fluctuated quite dramatically. And this deceleration in that rate of change is really what has been celebrated by the talking heads in the headlines, even though on an everyday living basis, many folks are still feeling the pinch of the continual and somewhat rapid rise in prices. Another way of looking at it was this guy, John Michaels, put it like this: I used to weigh 200 pounds, and then he gained 5 in 2020, 11 in 21, so on and so forth. And it's like celebrating that you only gained 3 pounds this year, even though he's 234 pounds now compared to where he was. I just thought those were some funny, humorous takes on this whole smokescreen about where inflation is and where it's going. Well, that's all I wanted to cover here this week. I thank you for watching, and until next week, I want to wish you a great day. Thanks so much.